move.
Okay, so the long-term cycle is intact for Sun Pharma. That's the technical word coming in. But fundamentally, Sanju, what would your own view be? Because we've seen stocks like Sun Pharma, Lupin, etc. consolidate for a bit. Is this a good time to be increasing your exposure to these companies?
Sonia, I am not a big fan of Sun Pharma, at this point in time. While I do agree that, in the long run, there's a lot of money to be made there. The fact of the matter is that, no significant EPS increases will be seen before FY17, maybe FY18. I'm not perturbed by the fact that despite a 50% jump in sales in the fourth quarter, the profit after tax crashed by 40%. It was obvious that the Ranbaxy integration costs, would take their toll. But what really spooked me was the fact that the operating margin came in well below consensus at just about 14.5%. And even if you account for the fact that, R&D spend went up to about 9% of sales, and you add that back, the operating margin was just about 22 or 23%, which is still a far cry from the 44% that they logged in for the same quarter in FY14. So, that's a huge fall, and my personal sense is that Sun Pharma has had a brilliant run, ditto with Lupin, though of course in FY17, if you're talking of an EPS of 73 rupees, then Lupin certainly looks far more attractive with respect to valuations than a Sun Pharma. That said, at this point in time, the pecking order that I'm looking at in pharma would be Cadila, followed by Wockhardt, and perhaps Cipla. The reason I like Cadila is that if you look at the fourth quarter numbers, they were excellent. It was picture perfect with an 18% jump in sales, a 40% plus jump in PAT. The profit before tax was actually extremely sharp with a 60% plus jump. And mind you, this despite the fact that the company has been firing on only one cylinder. Their Latin American business has yet to see traction. Their joint venture sales have been muted. The India business grew by just about 9%, but the US business grew by 44% year on year. And even if the stock moves up to 2,200 or so, it would still be trading at just a little over 20 times FY17. So there's a valuation comfort there. But more than that, the fact remains that this is a $6 billion company. And if they do manage to acquire Claris Life Sciences, which has presence in 70 emerging markets, the geographical diversification, I think that will certainly work wonders for them going forward. And while, the management has chosen to play safe on that front, I'm looking at some positive announcements on that front. And, Claris will be a very small acquisition for them, but with big benefits, because don't forget that Claris has just about a market cap of $210 million odd. So I think Cadila, and followed by Wockhardt, which I think has seen a steep correction all the way from 1900 to sub 1400 levels. So, I'm not factoring in at this point in time any positive EPS, accretion from their Waluj or Chikalthana plants. But even if the Aurangabad plant, adds something like $70 million to their sales in FY17, you're talking of an EPS of something like 85 rupees. But if Waluj and Chikalthana add to the US sales, then, the incremental number in the US sales could be anywhere between 120 to $250 million, which means you're talking then of an EPS of not 85 rupees, but 125 rupees. So, then the run up to 17 or 1800 or back to 1900 is certainly there for the asking. And of course, Cipla, which I think, again, is a story that has been evolving. It has had its fair share of issues with respect to, FDA import alerts. But I think it's still one of the better valued stocks within the space. So that is the pecking order for pharma.